Hello everyone and welcome to this AJ Bell Managed Portfolio Service update for Q1 2020. Thank you very much for joining this short run through what has been a tumultuous quarter for markets across the world and indeed of course all of the global population. What we're going to look at today is a brief introduction to the AJ Bell Investments Service, a review of the MPS performance over the first quarter, indeed also looking at how markets have done over the first quarter, and then we'll look at each of the individual services that we offer: the passive range, the Pactive range, the active range, and also looking at the recent changes that have been made to the portfolios, as well as trying to give some kind of outlook as to how we see things playing out over the rest of the year. So let's just jump straight in to a brief bit about AJ Bell Investments. We were launched in 2016 to help provide some investment solutions to the broader business, and we're already managing a very good sum of money for advisors across our range of solutions. So thank you very much for your support so far in trusting us with your clients' money. It is very much appreciated, and we will certainly never forget whose money it is. Now, there are a very wide range of services here: the passive and active, on the growth side, the passive and active on the income side as well as Pactive for those of you that want some exposure to actively managed funds and some to passively managed, and of course our existing passive range of growth funds and income funds. So a quick look at performance. Clearly, the first quarter of 2020 has been incredibly volatile, one of the most volatile periods in stock market history, and we need to go back to look to 2008, 2009 financial crisis to find something similar in terms of volatility. Now, of course, there are far greater issues to worry about than simply market volatility, given everything that's going on in the world. But it was a challenging period of time for all types of assets, for equities, for bonds, right across the board, for alternative assets, and there was really little hiding place over the quarter for people to shelter from the very worst of the market falls. Government bonds were certainly one place where you could have some of that, and we'll look at our government bond exposure in a little while. But you can see here over the quarter the cautious portfolio, the MPS 1 on the passive side, being down just over 6%, ranging right through to the highest risk passive 6 portfolio, which is down 18% over the quarter. So it really highlights the dramatic falls that we've seen in markets over the last 3 months. In fact, really, it's come a lot quicker than 3 months. Most of it came just in the last 6 weeks. Income funds as well, income strategies as well, were also quite affected. Income investing as a style, I mean, often during market falls, you would find income investing to be quite a decent way of protecting investments. Often in history, income strategies have fallen less than the broader market, given the cushion of the dividend that's been paid by companies. But clearly, with the way the global economy has stopped, this is a very different situation where dividends have come hugely under threat, and already many companies have announced that they are cancelling their dividend. And so dividend investing hasn't been the cushion that it often has been in history, and that has seen equity income falls around the world fall quite sharply over the first quarter. Turning to active investing, well, it was a broadly similar pattern. The active strategies are very similar performance to the passive strategies over the period, and we'll look a little bit later at how the different contributors to the performance within the portfolio. But active investing was no real hiding place again over the quarter. On a general basis, there were pockets of styles that protected against the very worst of the falls, and there were other parts of the market that fell very severely. So it certainly was a very broad spread of returns over the period. And the passive strategies that haven't quite been running quite as long, haven't got a 3-year track record here, but they perform very similar. You'll recall that the Pactive strategies are a mix of around 50% of the in a passive AJ Bell strategy and 50% in the active strategy. And needless to say, performance is broadly in line with the numbers you've just seen on the previous two slides. So let's turn to market performance and have a look at what we've seen across the different assets over the quarter. I mean, as you can see here, for the first, well, really for the first half of the quarter, our markets were just ticking along, a little bit of growth, as market participants thought that the world economy was in reasonably robust shape and should grow throughout 2020 with modest economic growth around the world, but certainly not too many major events to worry about. And then, of course, there was an abrupt change. Over the course of January into February, we saw the coronavirus pandemic, as it now is, but at the time was relatively restricted to China and Hong Kong and Korea, certainly in January. But as events moved through, then clearly we saw that spread right across the world, and there was really no hiding place other than in government bonds, as we've mentioned. So the best performing asset class over the quarter was government bonds, either in the US or the UK. You can see a return of over 6% here from conventional UK gilts. US Treasuries performed a little bit stronger, but actually very quickly you jump to negative returns. Corporate bonds, even higher quality investment grade corporate bonds, fell back over the quarter as the real threat to companies' very survival as we move through this crisis becomes a very real issue for investors. And so we've seen corporate bonds fall over 5.5% in the quarter. Emerging market debt very much struggle. High yield bonds, obviously, they're much more related to equity and have more leverage balance sheets on very often, and a more risk from this slowdown. Then they really have fallen sharply. Now, when we look at equities, well, let's jump straight to the bottom. The UK equity market was the worst hit in sterling terms. I should say this is all in sterling, these numbers here. And so the UK market was down 25% over the quarter. Now, we've seen days when markets have moved 10% both up and down in a day, unprecedented levels of volatility. And overall, the MSCI World down 15.5% over the quarter. A little bit of a mix, actually, when we look. Japan, the equity market actually not down as badly as the rest of the world. Now, really because Japan, there's been some signs of moving through this crisis, and an element of normality beginning to resume in Japan and indeed in China, and that helped the performance of Asia markets. And as you can see there, both especially Japan. So let's look at a little bit more of that economic and market review in detail. Well, clearly the global economy has come to effectively a standstill in the first quarter, and that has clearly major implications for companies right across the world. Their equity markets higher, with volatility higher than we saw in the financial crisis, and as we say on the slide there, the S&P 500 recorded its second fastest 25% fall in history, only behind the 1987 crash. So these are incredibly volatile times. Now, what we've seen the last couple of weeks is governments and central banks really step in and look to support the economy, workers, the population, with interest rate cuts, with really unprecedented measures to try and protect people's jobs as governments really grasp the scale of the crisis that we have, and hoping to avert the very worst of mass unemployment. That is a very real risk, and indeed we're seeing signs of that's already happening in certain economies as the speed of this crisis grows so quickly. Now, as we mentioned, Asia was quite resilient, with China getting back to work, and actually we saw the domestic China stock market perform very, very well over the quarter. It fell sharply in January as the crisis really escalated, and the government stepped in, and the market recovered quite quickly, actually to the tune where Chinese domestic equities have outperformed MSCI emerging markets significantly over the quarter, perhaps in a way that very few people would have thought. Now, fixed interest was very, very mixed, as we saw in the previous chart. Government bonds were really the only positive, and longer duration bonds, as central banks slashed interest rates to as good as zero, and government bonds responded accordingly, but not without volatility. Even within government bonds, there was enormous volatility. Now, looking at volatility, this is a chart of the VIX index. So it looks at the options market and tries to put a price on volatility. And we can see, as we get to March, we can see that enormous escalation in volatility in markets to a level not seen even during the very depths of 2008, 2009 financial crisis, when many thought the whole financial system was likely to collapse. We've seen an increase in volatility greater than that level, as it really is unprecedented times that the entire global economy could come to a standstill in just a few short weeks. And I guess that reflects that I'm giving you this webinar sat here at home, where I live here in Salisbury, looking out across the Wiltshire countryside, and hoping right now that my wife, my daughter, or either my cat don't come interrupting me as I give this from my office. So apologies if you do hear any background noise, but of course reflects the way that we're all having to work right now. So looking at currency markets, now this is a longer term chart over the last year, but what I really wanted to focus in on was the extreme volatility that we've seen in the last few weeks. As a consistent theme here, and quite remarkable how the sterling dollar rate has fluctuated over the quarter. It started the quarter at around 130. We saw some strength in the second half of last year as we looked to be getting some kind of resolution to Brexit. But that completely changed when we saw an enormous risk-off move in late February, early March, when the sterling dollar rate fell from over 130 to back just below 115. Really amazing moves. Now, a lot of that was caused actually by a dollar squeeze, and that is that the rush for dollars across the world by investors was so great. There wasn't actually enough dollars out there to satisfy demand, and therefore it drove the rate higher and higher. The dollar strength around the world getting stronger and stronger, not just against sterling, but against every other currency, every major currency that there was, and really unprecedented moves. Now, as that central banks unleashed liquidity into the market and the Federal Reserve unleashed liquidity in dollars, you saw a very large snapback from that 115 level back up close to 125. So some huge volatility there, which has major implications for investors that have exposure to overseas assets outside of sterling. And any given day, when you translate that back into sterling, depending on where that sterling dollar rate is, has a major impact on the level of return that you will see. So looking at the gilt market, well, actually a very similar picture here. Again, enormous volatility, a consistent theme. And now what's interesting here is where gilts are pricing either risk on or risk off. So we saw, as you get to the back end of the chart there, we saw the 10-year yield move from above 60 basis points down to below 20 in very short order, and then rapidly widen up to 80 basis points, and then rapidly fall again to under 40. Now, in theory, this is from what should be perceived as one of the most secure assets in the market, and in theory, one of the least volatile. But the scale of moves that we see over the last few weeks really take that thinking out of the window in terms of just how volatile these assets can be. So let's look at jobs. This is a 5-year chart of US jobless claims. What we can see here is the scale of the change in the last couple of weeks. And actually, there's some more data to update you on in just a second. But basically, US jobless claims have been running at around 250,000 for a very, very long period of time, as you can see here, with this essentially flat line between April 2015 and March 2020. And 2 weeks ago, we got the first jobs update from the US, and these jobless claims went from 250,000 to nearly 3.5 million in a week. Now, if we update this chart to today, then the data that came out just at the very end of last week, that number has almost doubled again to well over 6 million unemployed in the current period. Now, so essentially, that number has gone from 250,000 in 1 week to 2 weeks later to 6.5 million, and that's before any real impact of a shutdown in the US economy. These figures are just truly off the scale. They are unprecedented, and you can see why governments and central banks have acted so quickly to put every kind of support there is into the market, into the economy, to try and avert a truly terrible catastrophe, really, for populations across the world. We will look to see how these numbers evolve over the next few weeks as the US moves through, the virus moves through the US, and indeed here in the UK, of course, a very, very similar situation. These are really unprecedented times. And just one other economic issue I wanted to look at exactly the same time as we had markets beginning to fall with the impact of coronavirus. We also had the oil price collapse of 30% in 1 day as Saudi Arabia and Russia fell out over what was the best way to control oil production. And essentially, both sides have said that they will keep on pumping oil regardless as to what it does to the price. And unsurprisingly, a huge glut of oil in the market, just as the economy comes to a complete standstill, and therefore the demand of oil completely collapses. So you get a supply glut and a demand completely falling off a cliff. Then you've got the oil price falling very sharply. So it fell to about $20. It's rallied at the time of making this webinar. It's rallied back to about $27 as hope that they'll come to some side of agreement. But there is significant volatility again in the oil price. Now, in the long run, as we come out of the other side of this crisis, which hopefully we will begin to do over the next few weeks, is that much lower oil price will prove to be a very big positive for global markets and for the economy to be able to get back on its feet. So that's something, again, we will watch very carefully. So turning to the actual portfolios, now, as we mentioned, there was little hiding place whether you're an active or passive investor over the quarter. Within the portfolios, exposure to government bonds, both in the UK and the US, was a small element of positivity. Clearly, you've seen the scale of the falls in the portfolios over the quarter. Now, some of that was cushioned by exposure to UK gilts, to US Treasuries, and actually we added more US Treasuries just before the equity market, perhaps actually the day before the equity peak. We added some US Treasuries to the portfolio, so that has certainly helped some of the portfolios protect against the worst of the falls. Now, not because we had any insight that the coronavirus was going to cause an imminent collapse in global markets, but we actually saw them as a great diversifier in the portfolio, given how low yields had got in the UK, and that's actually worked out quite well. So exposure to Japan and Asia fell less than global markets on the whole. We increased our exposure to Asia in mid-February as well, before the fall. And we'll look at some of the changes we made just in a couple of slides' time. The UK equities were hit very hard here over the quarter, and that's a lot to do with the structure of the index. So, as you know, the UK market's got a very big weight towards oils and has also got a very big allocation to financials, two areas that have been hit very hard over the quarter. Medium-sized and smaller companies were also severely impacted, perhaps unsurprisingly, by the market's falls and the economic slowdown here, as many companies, and there's no other way of putting it, many companies will struggle to survive as we come out the other side of this, and again, why governments are trying to do so much to support that. High yield and emerging market debt was very painful as yields widened, and certainly the strength of the US dollar has hurt some emerging market countries that borrow in dollars. So we've already seen some downgrades to the likes of Mexico and Nigeria from the rating agencies as they see some challenges to the performance, to the economic performance of those countries. So just turning to the growth portfolios on the active side, just to talk about a couple of the highlights and the detractors. We mentioned government bonds. We have exposure to both the 1 to 3 year short-dated US Treasuries and the medium-term dated Treasuries of 7 to 10 years. They both performed strongly. Now, we do build a diversified portfolio when we construct these, and we like to have exposure to managers that we think should give us some defensive characteristics should the very worst happen, not on a tactical basis, but on a long-term basis. And Trojan Income very much showed its defensive characteristics, significantly outperforming the FTSE All-Share over the quarter. Now, of course, still down to a reasonably large degree, but certainly nowhere near as large as the market. Now, one big plus over the quarter for the active portfolio was not owning any UK physical property. They form part of our universe, and those of you we've spoken to over the last couple of years will know that we've seen potential problems coming in the property market for a while now, and hence have been zero weighted. Over the quarter, given the uncertainty that exists in the pricing of the market for physical property in the UK, all of the major property funds suspended with an inability for anyone to get their money back. And therefore, we feel that our positioning has been vindicated over the quarter to not own any physical property funds at all in the portfolio there. Now, clearly, these are small crumbs of comfort given the scale of market falls across the board, but I think it is important to recognise our approach and our tactical positioning there has paid off over the last couple of years, given these funds are now all suspended. Now, on the detractors side, any kind of exposure to value investing has been hit incredibly hard over the last couple of weeks. Value investing has been out of favour for a long time, and we did see some attractive valuations in the market. Value investors have been exposed to things like oil and energy, to financials, to mining, and these were places that looked quite attractively priced given the fact the global economy was actually looking like it was pulling through in okay shape before the virus hit. So these types of investments have been hit very hard. If you think about what's happened to BP and Shell over the last few weeks, if you think about what's happened to EasyJet over the last couple of weeks, and indeed financials and banks, and you can see why these value managers have been hit very, very hard. In the emerging markets, growth was a style that underperformed, and therefore exposure to Fidelity is a little bit painful in the short run. It's been a very strong long-term winner for us, but this focuses on the quarter, and so we highlight here that that's been a more challenged quarter. And indeed, as I mentioned right back at the start, with equity income investing in the US, our exposure to JP Morgan US equity income underperformed as exposure to financials hurt. And of course, here in the UK, with banks announcing that they would not be paying their dividends, again, income investing has been a challenged area over the last few weeks. So looking at the income portfolios and turning to that, so equities and fixed interest were both weak. In the income strategies, there was limited exposure to government bonds given yields were already so low. So there wasn't the same ability to cushion the blow in the income portfolios as there was in the growth portfolios, because that would have come at a big expense of not being able to generate the income. There's a small exposure to US Treasuries, which helped, but high yield and EMD, as we mentioned before, were painful. Now, in this portfolio, we do have some exposure to property equities, and given the yield that was on offer, now these have been hit hard, again, given the uncertain corporate backdrop that we are seeing, and so that was a painful exposure for the portfolios. So let's just turn to some of the activity that's gone on over the quarter. So on an annual basis, we update the long-term asset allocation of the portfolios, and on the growth strategies, these were implemented in February, just before the big market fall. So just running through a couple of highlights here. So at the lower risk end of the portfolios, cash was increased, been a little bit helpful over the last few weeks. Fixed interest exposure was reduced in the lower risk portfolios, certainly with weight to UK bonds coming down. On a long run basis, these assets have looked less attractive given where yields had fallen to there, and yields in the US and emerging market debt had looked more attractive. And may well potentially do so even more today, particularly in emerging market debt. In the equity element of the portfolios, then Asia and emerging markets was increased across the board, with US mid-cap falling in its exposure, and UK mid-cap falling in its exposure, and Japanese equities too, as the long-term attractiveness of Asian emerging markets increased there. So an added allocation to those part, and alternatives exposure, so that's the property or absolute return exposure in the active growth portfolios, was reduced a little across all portfolios. Now in the income portfolios, no changes were made during the quarter. The asset allocation is updated, will be updated in around the middle of this month. Now clearly, with what's happening with dividends across the world and the number of companies suspending or cancelling their dividends, then this is something that clearly we're very focused on to make sure that we've got exposure to the right areas there. But there's a lot of information to absorb, and this is a part of a story that's only just really, I think, beginning to be seen. So it's keep an eye out on our website and for communications as to our plans and changes that we are making into those elements of the income portfolio. So just trying to wrap this up, it's a brief run through the quarter there with a little bit of an outlook. Now clearly 2020 started in unprecedented fashion. No company budgets for having zero revenue for 3 months here. So I think we're in an unknown territory for what the long-term outlook for growth is, what it does to economies in the short term, in the long term. Quite clearly, some companies will not survive the impact of the coronavirus, and others will only survive with government support. This is a very, very uncertain time for income investors, as we've just mentioned, and it'll be a challenging time, I think, for a little while to come. Now, let's look at some element of positivity. Tentative signs of early progress in Asia, Korea, China, Japan, resuming some element of normality over the last couple of weeks, and we are hopeful that in Europe and in the US we can see similar progress, as we're a little bit later a little bit earlier, in the movements of the coronavirus through the population. So hopefully, by the time we report to you at the end of the next quarter, we will be in a different situation. Now, also the final point, just to make, huge expansion of government balance sheets over the last couple of weeks. So they've announced all kinds of support for the economy, has driven yields down further. The long-term impact of what this does to the bond market, I think, remains unclear at this stage. It's something we're talking to all the managers we have exposure to at the moment, and we'll continue to discuss and debate what the whole impact of coronavirus has on the global economy over the coming weeks, months, and indeed years, given the scale of the impact of this on investors and the population. So we put out various articles and updates. The written quarterly report will be available on our website. There's fact sheets, there's articles we've been writing on what's going on. Do keep a look at our website to keep up to date with our latest thoughts on what is happening. It's clearly what I'd like to say certainly is I hope those of you listening have managed to stay healthy and stay well, as have your families, your friends' families, and loved ones. These are very, very challenging times for everybody. We hope that you stay safe and healthy over the next weeks and months. And if you have any queries about any aspect of your relationship with AJ Bell in the managed portfolio service, our funds, or any other part of it, then do please get in contact with your usual AJ Bell contact. We would be delighted to talk to you either via email or via phone to answer any of your queries, questions, or concerns that you have. So that just leaves me to wrap up this quick run through the quarter. I mean, so much has happened over the last 3 months. We can't really do it justice in just the last 20 or so minutes, but do read the longer document explaining our thinking, and I'll leave it there and look forward to speaking to you again soon. Thank you very much for listening.